Growth stocks are thought to have the potential to outperform the overall market in the long run, due to their future potential. On the other hand, value stocks are companies currently trading below their true value, thus providing a superior return. Which category is better? Today we find out more. Hello, this is Financial and Investment Wisdom. Today's video will discuss the performance of value stocks and growth stocks. But first, please subscribe to the channel and turn on notifications to be notified of every upload. The concept of a growth stock versus an undervalued stock is generally derived from fundamental stock analysis. Analysts believe that growth stocks can outperform either the overall markets or a specific subsegment of them over time. Growth stocks can be found in small, mid, and large cap sectors, and will only remain so until analysts believe they have reached their full potential. Growth companies are thought to have a good chance of significant expansion in the coming years, either because they have a product or line of products that are expected to sell well, or because they appear to be run better than many of their competitors and are thus expected to gain an advantage in their market. Value stocks are typically larger, more established companies trading lower compared to what analysts believe the stock is worth based on the financial ratio or benchmark to which it is being compared. For example, based on the number of shares outstanding divided by the company's capitalization, the book value of a company's stock may be $25 per share. As a result, if it is currently trading at $20 per share, many analysts would consider it a good value buy. For a variety of reasons, stocks can become undervalued. In some cases, public perception will drive down the price, such as if a major figure in the company is embroiled in a personal scandal or if the company is found to be engaging in unethical behavior. However, suppose the company's financials remain relatively stable. In that case, value seekers may see this as an ideal entry point, assuming that the public will soon forget about whatever happened, and the price will rise to where it should be. Value stocks usually trade at a discount compared to the price to earnings, book value, or cash flow ratios. But, of course, neither outlook is always correct, and some stocks can be classified as a hybrid of the two, where they are considered undervalued and have some upside potential. As a result, Morningstar Inc. categorizes all of the equities and equity funds in its ranks as either growth, value, or blended. In a nutshell, value investing seeks to invest in companies undervalued compared to the market. Price to earnings and price to book are two methods for determining the valuation. On the other hand, growth investing seeks to invest in companies that are rapidly increasing their revenue earnings and cash flow. As a result, valuation metrics frequently show that they are overvalued. Here's how these two investment strategies have fared over time in companies with both large and small market capitalizations. Large cap value and growth. Whether value or growth outperforms is entirely dependent on the period under consideration. This is especially true for large cap companies. According to the Federal Reserve, $1,000 investment in high growth companies in June 1978 would have grown to more than $30,000 by the end of 2007. A similar investment in high-value companies would have grown to nearly $40,000 in value during the same period. Extending the analysis period to the present, on the other hand, produces very different results. The growth investment would have increased to more than $128,000 by November 2020. The return on investment would have been just under $94,000. In both cases, the periods under consideration span decades. However, the recent outperformance of growth stocks has reversed the results. Now let's talk about small cap value and growth. The case for value investing is strongest with small cap companies. A $1,000 investment in small growth companies has grown to around $96,000 as of November 2020, up from $1,000 in June 1978. A similar investment in small value companies outperformed this significantly, increasing to around $150,000 in value. Nonetheless, the case for small value companies is murky for at least two reasons. Much of the return data, including that from the Federal Reserve, assumes a lump sum investment at the start of the analysis, with no additional contributions or withdrawals. When considering contributions or withdrawals, the sequence of returns, or the order in which you earn returns, becomes important. Second, the period under consideration is unlikely to correspond to an individual investor's actual investment horizon. When both of these issues are taken into account, the outcomes can vary dramatically. While small-cap value stocks have outperformed growth since 1978, a 1990 investor would have had a very different experience. As a result, using different starting and ending dates, even over decades, will yield different results. Some outcomes favor value stocks, whereas others favor growth stocks. Performance chasing. The shifting tides of the value versus growth debate may lead some to pursue performance. Because growth stocks have outperformed value stocks for more than a decade, some investors may be tempted to increase their investments in growth companies. Some have even questioned whether value investing is dead. In contrast, pursuing performance can result in lower returns. Vanguard discovered that a buy-and-hold investment strategy outperformed chasing performance across all asset classes in one study. The buy-and-hold strategy performed particularly well with small-cap companies. Of course, one could invest in small-cap value stocks and hold them for a long time. However, as previously stated, this approach may or may not result in higher returns over a given investment period. Furthermore, there is some evidence that growth stocks' outperformance is coming to an end. According to one JP Morgan study, value stocks could outperform growth stocks during a recession or when inflation and interest rates rise. While forecasting the next recession or rising interest rates is difficult, there is no doubt that they will occur. Value stocks are more likely to outperform growth stocks when this occurs. Because it is impossible to predict what will happen in the future, a mix of value and growth stocks may be the best long-term strategy for buy-and-hold investors. Hey there! Before we discuss our opinion regarding which is better between value stocks or growth stocks, please give this video a thumbs up. And please feel free to share your thoughts in the comment section below. Which performs better, value stocks or growth stocks? When comparing the historical performance of the two respective stock subsectors, any results that can be seen must be evaluated in terms of time horizon and the amount of volatility, and thus risk that was endured to achieve them. Because they are typically found among larger, more established companies, value stocks are thought to have a lower level of risk and volatility associated with them. Even if they do not return to the target price predicted by analysts or investors, they may still provide some capital growth, and these stocks frequently pay dividends. Meanwhile, growth stocks typically do not pay dividends, and instead reinvest retained earnings back into the company to help it grow. The risk of loss for investors in growth stocks is also higher, especially if the company cannot meet growth expectations. For example, a company with a highly touted new product may see its stock price plummet if it is a dud, or has design flaws that prevent it from functioning properly. In general, growth stocks offer the greatest potential reward and the greatest risk to investors. Let us now take a look at historical performance. Although the preceding section implied that growth stocks would outperform over longer periods, the opposite has been true. On the Seeking Alpha website, research analyst John Dowdy published a report. He divided stocks into categories that reflected the risk and returns for growth and value stocks in the small, mid, and large cap sectors, respectively. According to the study, value stocks outperformed growth stocks on a risk-adjusted basis for all three capitalization levels, from July 2000 to 2013, despite being more volatile than their growth counterparts. However, for shorter periods, this was not the case. From 2007 to 2013, growth stocks outperformed all other cap classes. The author was ultimately forced to conclude that the study did not provide a definitive answer to whether one type of stock was truly superior to the other on a risk-adjusted basis. He claimed that the winner in each scenario was determined by the period in which they were held. Overall, the decision to invest in growth versus value stocks is ultimately determined by an individual investor's risk tolerance, investment goals, and time horizon. However, it should be noted that over shorter periods, the performance of either growth or value will be heavily influenced by the market's position in the cycle. Value stocks, for example, outperform during bear markets and economic recessions, whereas growth stocks outperform during bull markets or periods of economic expansion. This factor should be considered by short-term investors or those attempting to time the markets. That's it for today's video. Please make sure to subscribe to the channel and turn on the notifications to be notified of every upload. This is Financial and Investment Wisdom, and we hope to see you on our next video.